Good morning, good afternoon, good morning, depending on which part of the globe you're at. This is the Payment System Broadcast session 21st. Welcome, everyone. Today, we're going to have rethinking FX settlement cycles. I'm going to allow a couple of seconds for people to join. Welcome, everyone. Okay, in the meantime, I'm going to start the housekeeping. So as everyone knows, in this series of payment system broadcasts, what we normally do is we have a lively conversation with our speakers. This will take about 45 minutes. And afterwards, we're going to have the questions and answers. And to get those questions on the air, please submit all your questions via the Q&A widget that you will find in the right bottom part of the WebEx app. Good, so let's start. So once again, welcome to this 21st session of the Payment System Broadcast Series. Today, we're shifting our focus to the world of FX settlement and how increasing the frequency of settlement cycles might affect liquidity, efficiency, and systemic risk. Joining me today for this fire chat, which is a little bit different from what we usually have, we have today Emmanuel Villa, who is Director of Corporate Strategy and Innovation Lead at CLS. By the way, CLS, as most of you should know, is the largest financial market infrastructure and the backbone of PVP settlement in FX markets. Our objective today is to explore the key findings of a joint study that CLS and FNA developed and published a couple of days or weeks ago, in which we look at the implications of shortening settlement cycles in the world's largest financial market. So this conversation will cover how CLS settlement works today, why this matters, and why these conclusions are important and what they might mean for the future of FX payments. So to start, welcome, Emmanuel.
Thank you very much, Carlos, and it's a pleasure to be here in this podcast, and thank you to everyone who's made the time to join us. So a little bit about me, who I am, and why I'm part of this today. So I joined CLS in 2024. I'm the Strategy and Innovation Director at the CEO's office. Primarily, I'm responsible for supporting the shaping and execution of the corporate strategy at CLS, and also driving innovation initiatives across the organization, which is whether it's through existing technologies or emerging technologies like distributed ledger technologies and artificial intelligence. Prior to joining CLS, I was at Ernst & Young for 10 years, where I was a management consultant. There I was helping our capital markets and payment client franchise embark on transformation type projects. And it was through that experience actually that I also had the opportunity to get involved in some industry-wide projects. I led the business work stream of the Regulated Liability Network, otherwise known as RLN, but I also was involved in other projects like the Digital Gilt Roadmap and the future of FX. And so it's been this combination of FX, innovation, strategy, and a bit of risk management that culminated with me joining the CEO's office. And yeah, I'm very pleased to share some of the insights, as Carlos said, on this joint study that we've done with FNA.
That's great, Emmanuel. So let's get started. There's a lot of things to speak about and to cover. So just to start, Emmanuel, could you give us an overview of CLS role in the FX market and the value it brings to participants globally?
Yes, absolutely. So, Carlos, as you mentioned, we are an FMI, a financial market infrastructure. We operate in the post-trade space of the trade life cycle. For the FX market. As you will know, FX is the world's largest financial market. The BIS, in the most recent triennial study, estimated to be 7.5 trillion of average daily values, which, to put that into perspective, it's 15 times the size of the global equities market. So it's the biggest financial market in the world. Now, CLS was established in 2002 to eliminate effectively settlement risk, otherwise known as Herstatt risk. And for those who might be unfamiliar with this quite well-known story, I'd like to just spend a few seconds on that, because I think it brings to light what we actually do. So in 1970s, there was a small German bank called Bankhaus Herstatt. Now Herstatt was a player and active in the FX market. But then one day in June of 1974, many counterparties had transferred Deutsche Marks to Herstatt in Frankfurt during the trading hours, and they were expecting to get paid US dollars in New York, US hours, because of the time zone differences. However, before the US dollars payments were made, the German regulators actually closed Herstatt Bank at the end of the German business day due to insolvency. And so these counterparties never received their US dollar payments, even though they had actually already delivered the Deutsche Marks to Herstatt earlier that day. And so this event exposed a major flaw at the time in cross-border financial settlements, which is when you have time zone differences and payment lags, you have a risk. And that's the risk that one party could fulfill their payment obligation, but the other party will fail to deliver because of bankruptcy, closure, or default during the settlement process. And so here we are on this webinar, 50 years after that event, and more than 20 years since CLS has been established, and we remain committed to the same mission, which is reduce systemic risk in the FX market while improving funding and also providing operational efficiency so that clients can do business with confidence. And what that means in practical terms, Carlos, is, as you will know, is we offer a PVP settlement protection service across 18 of the world's most traded currencies, serving directly over 70 members and indirectly 37,000 participants, which makes CLS a de facto PVP solution in the global FX market, and it's at the cornerstone of this market. You will also hear in this conversation, and if you've also had a chance to read the study, we mentioned also CLS.net. So there's other services that we provide. CLS.net is an additional service, which is a bilateral netting calculation service, which means the settlement happens outside of CLS, but we help through bilateral netting reduce the exposure to settlement risk. So I hope that's helpful context of what we do, how we're positioned in the market.
And I would add something, Emmanuel, which is something that, I mean, when you read the history about Herstatt risk and how it affected the FX markets, is that normally you always read that Herstatt was not a big bank.
Yes.
It was not a big player. It was, let's say, average. And when we talk about payment systems, when you say that someone is average, it means it's not very large. Normally, it's rather small. And one of the main things that perhaps it's to learn or was learned afterwards, it's about complex systems. And that's something that we're going to speak a little bit more about later on this conversation, because at the end, what we need to understand very well is how complex systems as payment systems work. And in that, I mean, to fulfill that purpose, having digital twins and good modeling will allow us to understand how a small or average player in the FX markets had a ripple effect, such as the one that Herstatt caused in the FX markets at that time. And that's something that could happen today, once again, if we don't have the right measures to counterparty risk, which is what CLS is about at the end, is providing the PVP solution, netting, I mean, the liquidity saving mechanisms for the FX market not to fall into those kind of risky places once again. So I think that's something interesting as well.
Yeah, thank you, Carlos. Yeah, I think the importance of what you said cannot be overstated. I think FX is one of those markets that is so interconnected with everything else. I mean, if you're an investor purchasing a bond somewhere, you will need to get the currency of that respective bond issuer in that market. So FX is at the cornerstone of financial markets, and we are the de facto solution provider for PVP settlement to make sure that that's safe. So that's what also makes this study quite unique, and I'm sure we'll get into it in more detail. But it's the fact that we have visibility of this market, of this vast market, that also allows us to do the study with empirical data. And I don't want to spoil the findings. We'll get to that. But yeah, I think that's a very important point.
Great. The second question has to do with how does CLS settlement operates today? Can you give us like a walkthrough how it works?
Yeah, absolutely. So I'll spend a bit of time on this, if it's okay, Carlos. I think this is quite crucial to understand because it's central to then the impact of netting efficiency, and we'll get into the details. So every day, CLS will receive trillions of payment instructions that are submitted by the market participants. These payment instructions are matched, and then they're queued for settlement to take place at a point in time. And I emphasize this point in time because there is a time difference between the payment instruction, the execution, and the payment instructions being submitted, and the settlement happening. And we'll revisit that in a second because it's quite central to the study. But just what happens operationally on the day. So on the day of settlement at midnight, before the settlement cycle starts, we will issue an initial payment pay-in schedule. So that will show all members what are the net pay-ins that they have to pay in total. Post midnight, that will also trigger a number of some liquidity saving mechanisms, and we will continue to receive payment instructions up until a cutoff point at 6:30 a.m. So that's the final cutoff. And we need a final cutoff because we need to take everything that's been submitted and to calculate the final positions, the multilateral netted calculations, so the members know what they have to pay. At 6:30 a.m., we will then issue a revised pay-in schedule, which will specify the minimum amount that every member must pay at a certain time. And now the payments can be broken down into smaller chunks to further minimize the draw on liquidity. And at around 7 a.m. CET, by the way, I should specify this is CET, Central European Time. At around 7 a.m., the settlement cycle will begin, where each member will start paying in the netted amounts to CLS, either directly or via a Nostro. The system will then take the pair of match payments instructions from settlement queues, check that they satisfy the risk management tests and criteria, and then the relevant instructions will then be settled on CLS's book atomically, simultaneously, and with finality. So this becomes irrevocable. And this process typically happens all the way up to 9 a.m., usually sooner, but that 9 a.m. is the target, what we call the settlement completion target time. The pay-in and pay-out of long balances will continue until midday, but effectively after afternoon, effectively after 12 o'clock, the member balances will be zero. And that will complete the settlement cycle, and that will be we'll be doing the same process again the next day. So it is one settlement cycle per day. Now, I did say I'd come back to the time difference between submitting payments and actual settlement taking place. So this is a very important point. Most FX instructions in CLS settlement, they settle 2 days after execution. So what we call T+2. There's a smaller portion that settle T+1, so the next day. And there is actually an even smaller portion that settle on the same day, T0. So that means the execution, the submission of the instruction, the matching, and the settlement happens on the same day. But the market convention, for the most part, Carlos, is T+2. Now, this allows time between execution and settlement because it maximizes the length of time to capture as many offsetting payment instructions as possible so that they can effectively cancel each other out through netting. And that would reduce funding requirements for the members. To give you a sense of what that means, effectively, by doing this and through additional liquidity saving mechanisms, we are able to reduce the funding requirements by 99%. And so we spoke about the size of the FX market and the role that we play in it. So in practical terms, what this actually translates to is that in an average day, we'll process over 7 trillion worth of US dollars of value, of average daily value in payment instructions. So when you net this down by 99%, effectively the market is required needs to only have 70 billion worth of dollars to be able to meet the same set of obligations. So that's a pretty significant liquidity saving. So yes, we're providing the settlement, the PVP protection that we spoke about, which is core to our purpose, but we're providing another very big benefit, which is the liquidity savings component. I'll pause there and see if anything else.
I think that the point of T+2, T+1, and T+0, it's a very interesting topic, in fact, nowadays. And this opens a little bit how we're going to address the next question, because the importance of this kind of study, I mean, why is it timely, is because there are several, I would say, questions and misunderstandings about how the FX market works. And we had, I'm not sure if it was in 2024 or 2023, we had CLS Dirk Bullman also here in this broadcast, and we were discussing exactly that, how there are several misunderstandings or misconceptions, better, of how the FX market works. It's very common for us to hear someone in our, I don't know, family or relatives saying, well, you know, I tried to send money from my bank account in, let's say, Colombia to the US, and it took 1 or 2 days. That's pretty inefficient. That's really inefficient. I don't know how the traditional banking industry works like this. And they should have everything on a blockchain, and everything is going to be with DLT, and it's going to be immediate, and that's more efficient. Well, the thing is that the misconception here is that we're forgetting what you just mentioned, Emmanuel, which is 99% decrease in liquidity usage. I mean, to send, as you mentioned, to exchange $7 trillion, you just need 70 billion per day. So the thing is not about efficiency, and it's not, I mean, it's about liquidity efficiency. It's not only about time efficiency. And that's why at that time with Dirk Bullman from CLS, we also discussed how difficult or how interesting or valuable is to explain the market and the industry and the people and the media and the people outside the industry how this works. And in that sense, there are many jurisdictions, for instance, which are working on wholesale CBDC projects. And those wholesale CBDC projects, either domestic or cross-border, normally are built to test how good or which are the benefits of immediate or atomic settlement. And what we have found out, for instance, and we have some documentation or some media reports in India, for instance, that the banks complained about it. That said that the RTGS system with netting cycles work much better than an atomic settlement wholesale CBDC with immediate settlement. Why? That's because the banks need to be efficient in the usage of liquidity. So this oversimplification around the benefits of instant settlement, many people think that this T+2 or T+1 is a technical limitation of the banking industry, and that's not the case. I mean, as you mentioned, CLS already has CLS.net, in which everything can be settled immediately, but that's something that banks do not do very often. I know that it has increased, but they do not very often because it's not efficient enough for the usage of liquidity. So this kind of work helps us to shed light on these kind of misconceptions and to bring good substantiation to the discussion about where should the market go from here.
Yeah.
What do you think about that, Emmanuel?
No, I agree, Carlos. One slight clarification: CLS.net is a netting calculation service. It doesn't actually do settlement. But I do also see questions on the chat around, you know, T+0 solutions. I think you're right, Carlos. I think a distinction needs to be made between retail and wholesale. This is not to say that there is no merit to instant settlement in certain places of the market, right? I mean, if I was to send money to my wife abroad, I'd want the money to be received immediately. Or if I'm a retail bond investor, I bought a gilt and I want to pay someone to do the extension of the house, I would like to be able to sell that bond and get the money immediately in my account so I could pay the builders, for example. So this is not to say that there is no merit to instant settlement, but I think it's important, as you said, to understand that when you deal with wholesale markets, the priority of the market participants are about, first of all, safety. So making sure we're using the safest form of settlement asset. So in our case, we settle with central bank money, but it's also efficiency, because we're dealing with such large value payments that it's important to minimize the liquidity draw. This is liquidity that has opportunity costs, right? If this is money that could be lent out, it could be provided as credit elsewhere. So it's important to emphasize that retail versus wholesale component to that as well.
That's right, and I think that in this slide, exactly that's what we can show or we can discuss, which is like we have like two corners in which we can have full netting efficiency, in which we just delay everything to the end of the day, which is in the right part of the slide. In this graph, what we have is to the left, if we have the type of CLS settlement in which everything is settled once per day or at the end of the day, then we have the 99 netting efficiency that you spoke about how CLS does it. But if we start increasing the settlement cycles per day, even going to have it like atomic settlement, like immediate and simultaneous settlement or everything, then we'll have less time or less delay in the payments, but the netting efficiency will require most likely everyone to pre-fund all the accounts and to be able to exchange those 70 trillion, they will need about the 70 trillion, which is not efficient as you just mentioned.
Yeah, I am. It's a very interesting one, Carlos. I actually was trying to think before this webinar, like what could be a helpful analogy to help people really grasp the concept of how important this netting efficiency is. So forgive me, this is not a perfect analogy, but I think of it like a train arriving at a platform to pick up passengers. The train waits a few seconds, the passengers get in, and then it departs the platform. The less time the train would spend on the platform, the less time you would have to fill the train with passengers before the doors close. And so what would happen if you wanted it to be designed in such a way that every person, the moment they step foot on the platform, they get on the train and the train leaves immediately? So you'd have to basically go to a model where you're effectively running a train for every single passenger. So you need many more trains to run much more frequently, as opposed to having fewer trains, run less frequently and wait on the platform to fill up with passengers. So in this parallel hypothetical universe, that becomes a pretty expensive proposition. So I just ask people as they think about this to substitute the time with which the train waits for passengers to fill the train with the same time allowed for FX instructions to be received. The more cycles you start to introduce and the faster, the closer you go to instantaneousness, the less time you have to receive offsetting flows, and therefore the less likely you are to find payment instructions that cancel each other out, and therefore the more liquidity you need to have available to meet the settlement obligations. And as I mentioned earlier, this has an opportunity cost. Money isn't free. It has to be borrowed or has to come from somewhere. And so this is because I can also see a question on the chat, about T0. T0 is like you said, Carlos, is not a technical limitation. T0 solutions in FX already exist, but they remain niche for the most part, precisely for this reason, because of the cost for liquidity.
And I think that the analogy that you just came up with, it's a very interesting one.
It's not perfect
because it's not, as any analogy is not perfect. But the thing is that I would like to emphasize, or not to emphasize, but to highlight, is that going back to this graph that we have on the right of the slide, is I only explained the two corner solutions, like 99% netting efficiency and whole funding of all the payments, the needing 70 trillion to be able to exchange 70 trillion. But obviously there are halfway. I mean, there's a halfway. So the question mark is, where should we locate the system, CLS or some other system, to find a sweet spot between the netting efficiency and the funding?
Yeah.
So that's exactly what this kind of exercise or study that we developed is going to try to test and iterate different configurations, different design options, to try to understand how changing very slightly something in a complex system such as CLS, how it will impact the outcome of a liquidity exchange in the system. And not only because it's interesting because it's CLS and is, as we already highlighted like twice, is the largest market and the largest financial market infrastructure. The ripple effects, or the let's say the effects in terms of well-being and development of financial markets and the economy at the end depend on these efficiencies. I mean, these are efficiencies that are not going to, should not be taken for granted, and these efficiencies obviously matter for how markets work and how they impact the well-being of people. So that's something that we should always keep in mind, right?
Yeah, absolutely, Carlos. And it's also important to maybe explain why we're even having this conversation in the first place, because I think that provides some helpful context. So I hope we've explained that, you know, the time difference between, you know, submitting instructions and settlement is beneficial because it allows netting to happen as much as possible. But more recently, what's actually triggered this sort of study is we've observed that the concept of same day or even instant, so not just T0 but instantaneous settlement, is getting some attention. And we kind of see this from different angles, Carlos. On one part, we see that our own CLSnet bilateral netting calculation service is increasingly having more same-day activity. So these are trades that match and settle on the same day, albeit outside of CLS. So there's a growth in the activity that we deem to be same day. There is a view out there in the market that, of course, as the settlement, as a settlement of securities becomes shorter, the cycles become shorter. Maybe that will also impact the cycles of FX. And you mentioned, you know, we both spoke about how interconnected FX is with everything else. So there's that belief. But I think it's also the discussion that's happening around same-day and instant solutions in the research and innovation community, particularly with some of the experiments in the wholesale CBDC space that you mentioned. So we observed that these discussions and the attention on same-day and even instant solution is intensifying. But what tends to happen is that these experiments and research, they tend to overlook the impact of same-day and even instant on liquidity that we've just mentioned. And so in principle, you need to run more cycles to get closer to instantaneousness or to enable more same day. Now, the FX community, I think, understands that as the settlement frequency increases, the netting efficiency decreases for all the reasons that we've explained. But what hasn't been understood to date until we've done the study is the practical questions. Exactly what is as you mentioned, the optimal number of cycles that could be feasible? When should the cycles take place? You know, sometimes the when is as important as the how many. And ultimately, what actually starts happening in real number terms to the netting efficiency as you go to 2 cycles per day and 3 cycles per day and so on. So I think it's just important to understand where this is also coming from and why it's so timely that we have this discussion now. Ultimately, the objective of the study is a first step to helping the industry understand that these practical questions need to be answered if we're going to be designing appropriate solutions in FX and possibly even beyond.
That's true. And that introduces like our fourth question, which has to do with what are we aiming for in this study? So from our FNA side, which we provided let's say the methodology and the platform to do this kind of study, there are several points that I would like to highlight. First, this study provides a complete framework to test and iterate how FX settlement happens. So, and this is something very, very valuable for the industry, and just because understanding how it works, I mean, how a complex system works, how just changing a little bit, how just changing the netting cycle from, let's say, 7 a.m. to 7:05, how it could change everything that is happening. And as in any other complex system, these slight changes could have very big effects on the outcome. In this case, in the outcome of how efficient the exchange of liquidity is. So this is in this sense what we were trying to do with building this modeling framework that we're going to perhaps to discuss a little bit more, is to enable CLS to evaluate the impact of these different features and design options regarding how and when to do these settlement cycles. So the first big question that we're trying to address here is how liquidity efficiency is affected by changing the features of the system. And this is a question that the owners and operators of financial market infrastructures always have in mind when they're trying to do a renewal, when they're trying to do an optimization of their system, because the markets are changing and people, as you mentioned, or the industry, as you mentioned, Emmanuel, everyone is talking a lot about moving from T+2 to T+1 and then to T+0. And so this for system owners and operators is important to have the tools to evaluate these kind of things. And also for market supervisors and overseers, because they are obviously interested in making sure that the systems and the financial market infrastructures provide safe and efficient functioning to the markets. So what is this? I mean, how this study aimed at shedding light on the impact of shortening settlement cycles from CLS point of view, Emmanuel?
Yeah, I think what we wanted to what we wanted to really achieve is effectively three things, right? We wanted to first understand what is the impact on netting efficiency. So that's one thing. Then determine if are there any benefits to having multiple cycles, and ultimately, if there are benefits, under what operational considerations do those benefits materialize? I.e., when should you be introducing operational additional settlement cycles? Excuse me. I just want to point out that this is nevertheless is a thought experiment at this stage. And so it's based on empirical data, but there are, of course, limitations to it. I'm sure we'll cover them at some point in this discussion. And there are more steps to take to validate things. But it's empirical to point out that this is at this moment a thought experiment, and it's not intended to. It's intended to promote the right discussions, but it's not a strategic decision to imminently head this way. So, with that being said, in order for us to structure this study, we really kind of based it around two main hypotheses. So hypothesis one, we anticipated that as you have more frequency of settlement, the netting efficiency will drop, but we wanted to understand exactly by how much. And I hope, Carlos, that's the bit that you start to shed some light on with the fantastic work that you guys at FNA did. And hypothesis two is what are the benefits and how can we quantify them so that we can ultimately be able to answer, at least theoretically, do the benefits of having multiple cycles per day outweigh any potential costs to efficiency? As you said, sometimes there's merit, sometimes the truth is in the middle. So maybe extremes are always can be dangerous, but there could be merit to exploring solutions that offer some like more cycles, maybe not instantaneously, but potentially somewhere that offers a bit more flexibility as well.
That's true. So now I would like to introduce a little bit what we did. And what we did in the FNA's parlance has to do with something that we and in these industries call a digital twin. So this digital twin, which is a digital replica of an existing or a vision system, grants the ability for us or an end user to flexibly and comprehensively test and iterate. And perhaps I would like to highlight that part: test and iterate different design options and policies. So in this sense, what the user would or is able to do is to create a digital replica of the system that they're trying to study. You can have that system built already, or you're planning to build it, and then by making slight changes to the design options or the design features and the policies that are included into the system, you can start understanding how this complex system works. Because at the end, all these payment systems or settlement systems are complex systems in the sense that, for instance, we don't know what is the impact of making small changes to the system. What will happen if I change the number or the frequency of the netting cycles? We don't know. We have an idea of what will happen. So that's why we can create that graph that we already showed. We know that there is a balance or a trade-off between the two corners, but we don't know the shape of the curve or the line that is going to connect those corner solutions. So at the end, you could try to do something very costly and unflexible, which is using like the traditional learning by doing approach, which is let's implement the change and let's see what happens. But obviously this is very costly, this is very difficult, and even you can do a pilot, not to make it like live, but pilots are cumbersome, pilots are difficult to work with, and they're costly. So this way of working with a digital twin, in which you create this very faithful digital replica of the system and having good data, and that's something that we're going to discuss a little bit later, you can have, or you can create a learning by simulation approach that will allow you to avoid costs and inflexibilities that other approaches will impose. So this makes this study unique in the sense that CLS, which has vast experience on how those systems works, because you own the system, you operate the systems, and also you have all the data that you need to run this digital twin, then this is a marriage made in heaven, in the sense that we have all the technology to do the digital twin, and we have all the data and all the knowledge from CLS to have a very good, a very clear understanding and modeling about how the FX market works from the CLS point of view. So that's really important. And going to the results themselves, and I know if we can change the slide to show the results perhaps, because I'm not seeing them. Or I can let you know a little bit about the results without the slide if we don't have it.
Yeah, and Carlos,
So,
important to say, right? These are the results of the first hypothesis, right? So hypothesis one being, how does netting efficiency drop as you increase more settlement cycles? Just to frame it into the two hypotheses. I think that's a helpful structure for the people to understand.
that's right. So in the hypothesis one, it was anticipated that the netting efficiency would decrease with more frequent settlement, which was the graph that we had before, I mean, with these two extremes. So what we did at FNA with all the knowledge and all the data from CLS is to build this digital twin in which we used 9.4 million payment instructions across the 7 major currencies in the world, averaging over 425,000 instructions per day. So what we did is to analyze different scenarios in which we varied the settlement frequencies. So we have in this slide on top of the number 1 is the baseline, in which we have the actual, how it works right now, the once per day settlement frequency, in which we know that the liquidity needs are about 178 billion. That's the liquidity which is needed right now. And then we introduce 2 different scenarios in which we have twice per day net settlement frequency, and also 3 times per day settlement frequency. So what we can see very easily in this graph is that the bars have are increasing, and that's what we expected from the graph that we have spoken about several times now, which is as you increase the settlement frequencies from 2 or 3, the liquidity needs will increase. It will increase in the first case when going from 1 to 2. It will increase in 26.8 US billion from the baseline. If we go to the 3 times per day, it's going to increase to 48.3. And this has, I mean, it sounds like a lot of money, and obviously it's a lot of money for the market, but in the terms of the percentage of or netting efficiency, which Emmanuel already discussed that at the beginning of our conversation, is about 95.8 liquidity reduction, is going to decrease slightly to 95.2 and 94.8. So those are rather slight decreases in netting efficiency, but obviously in terms of money, that's a lot of money. And as also Emmanuel commented before, the opportunity cost of that money, it's important and it's relevant not only for financial markets, but obviously for credit markets and so on and so forth. So the ripple effects of doing this are to be measured. And that's why this approach of building a digital twin and being able to get this very simple graph, which we all know that it was going to, I mean, we already knew that there was going to be a positive slope in the amount of liquidity that is going to be used and a negative slope in the netting efficiency. That's right, but we needed to have the numbers, and having the numbers will help everyone to substantiate any discussion about whether or not it's a good idea to introduce new netting cycles, or to increase the frequency of the netting cycles, or go to immediate settlement right away, which is the rightest part of the graph that we have referring to several times. So that's the whole point of doing this kind of modeling, which is having quantitative outputs that substantiate any discussion related to this, to making changes or the way forward with this kind of financial market infrastructures. I don't know if you have any other comment on about this, Emmanuel.
You know, I think it's very interesting, Carlos, and you know, people are seeing 3 settlement cycles per day, and maybe people are thinking, why stop at 3? Why not do 4? Why not do 400? Why not do 2 million settlement cycles per day? We wanted this study to be realistic in that we wanted to understand what's feasible for the wholesale FX market, and so we stopped at 3 because it was deemed that doing more than 3 settlement cycles per day potentially be too operationally challenging for the FX market participants and for the Nostras to orchestrate time critical payments. There is every settlement cycle comes with its own liquidity, as we said, impact, but also there's an operational element, there is a cost. You've got to imagine that there's also an operational element around failure management. Just like the trains that go instantaneously, to go back to that analogy, if you had trains going instantaneously and one train there is an issue, you inadvertently have less time to fix things. And so there is a lot of reasons why we thought in the study testing more than 3 cycles per day was not feasible. But again, it's one of those things that it needs to be validated. And this is why we said the study has limitations. There's some hypotheses made around that. But you can imagine that if you were to increase this and go beyond, we can run a very short thought experiment here on the webinar. If you were to go to more than 3x settlement cycles per day, eventually you could see the liquidity efficiency, netting efficiency drop. And eventually, when you are settling 2 million trades on a gross basis as they come in, you're effectively talking about a 0% netting efficiency, which means in practical terms, the market participants would need to have over 7 trillion of liquidity pre-positioned to be able to meet those obligations. So it's just quite an interesting finding, just to show that only, going from 1, which is today, to 3 already has an impact. And so you can then just extrapolate that as a thought experiment.
Exactly. And I think that's the whole point of, just to emphasize, the whole point of doing this kind of digital twin and using good data to do this modeling, because this will help anyone to enter the discussion with numbers. With good numbers about what is the impact of doing this or that. And the digital twins allow you to make this test and iterate approach, and will everyone take an educated decision making about what to do with the financial market infrastructure or the systems. So what about the second hypothesis, Emmanuel? Were there any clear advantages from introducing more settlement cycles? Because we're seeing costs, but what about benefits of doing this?
Yeah, so that's a very interesting question, right? So yeah, we asked this as a second hypothesis. We asked ourselves this question. And I think to be able to answer whether there are advantages or disadvantages, I would like to say it depends not only on how many cycles you introduce, but also the when. The when is actually quite important. So when do the actual cycles operate? And the way in this study, the way that we formulated the narrative was, you can think of what happens when you introduce additional cycles before 7 a.m., because currently that's the cycle that we run. So we'd run maybe one cycle at 1 a.m., one cycle at 5 a.m., and one cycle at 7 a.m. So we keep the current cycle. And another way to think of it, what happens when you introduce additional cycles post 7 a.m. So you keep the 7 a.m. cycle as it is, and then you introduce some additional cycles later in the day. Now, if I take these one by one, when you have additional cycles before 7 a.m., Carlos, you very clearly explained that there is clearly a netting efficiency drop, which then leads to about 48 billion worth of additional liquidity needed. Again, this is before any liquidity saving mechanism, so that could actually be reduced slightly. But there is a cost there. There is also another cost, if you potential cost or friction, in that if you start introducing cycles earlier in the day, potentially could impact market dynamics. So we know this anecdotally, that in some markets, perhaps in some Asian markets, market participants prefer to settle their FX obligations later in the day. So if you suddenly have FX settlement requirements at before 7 a.m., that might start creating competing liquidity priorities, and so they could create some frictions in the way that market dynamics function. So these were the sort of costs associated with cycles before 7 a.m. On the other hand, in terms of benefit, in this study, there was no evidence to suggest that there would be any benefits for settling before 7 a.m., especially if you were to settle before 3 a.m. Again, I speak in all hours are CET, because larger currencies like US dollars and their RTGS systems, Fedwire, are not operating at that time. And so it was quite clear to us that if you settle before 7, if you have cycles before 7 a.m., there are costs and the benefits are not perhaps as obvious at this stage. On the other hand, when we talk about additional cycles after 7 a.m., Well, this is where it starts to get a bit more interesting. So in principle, that cost that you explained, Carlos, which is as you have more frequency of settlement, you have netting efficiency drop. In principle, introducing later cycles might not impact the liquidity efficiency, because we are proposing in this thought experiment to keep the 7 a.m. cycle as it is. So the existing volumes that have matched and are going to sell at 7 a.m. remain untouched effectively. And so in theory, that shouldn't affect the netting efficiency that we capture today. Again, provided market behavior doesn't change, right? Because maybe the market may say, well, I have now available other cycles in the day, so maybe I'll shift some of that volume to a later cycle. But provided there is no market behavior change, the cost, the netting efficiency cost might be limited, perhaps not be a cost at all. On the other hand, there could be 3 benefits that we evaluated that could ultimately outweigh the liquidity impact when you have 3 cycles after 7 a.m. Benefit number 1 was, again, in line with our mission to reduce systemic risk in the FX market. We know that there is a same-day FX market today that sells outside of CLS settlements in the currencies which we already cover, but they're simply not eligible simply because they match after the cutoff time for the payment instructions to be. Sorry, they executed after the cutoff time for them to be submitted and then be matched to the CLS system. So in theory, if you were to have some cycles that happen after 7 a.m., in theory, you're allowing these additional trades that are happening outside of CLS that would be eligible otherwise to suddenly become eligible. And we estimated the size of this FX same-day market to be around 500 billion. And I can talk about it a bit later if we have time on how we calculated that. And it's also detailed in the study. But in theory, we could be reducing systemic risk in the FX market by an additional 500 billion, which is not a negligible amount. The other benefit is, of course, if you start to bring this 500 billion same-day volume into CLS settlement, well, all of a sudden you are taking what is being settled bilaterally between different banks without CLS settlement, and you're bringing that into a multilateral netting service. So if you imagine, the bigger the pool of trades that you have together, the more chance they'll find offsetting flows. And so we actually hypothesized and estimated that if you were to bring this 500 billion into CLS settlement, potentially just by virtue of offering them closer to 95 netting efficiency, you might be able to save an additional 240 billion in liquidity requirements per day, and that's pretty significant when you think about the sheer size of that. And the last but not least, of course, just where we stand in the ecosystem, we sit in the middle of settlement. There could also be some operational efficiencies by virtue of us sitting in the middle of settlement and standardizing the process, which means more straight-through processing, less failed trades, and other form of operational efficiencies that could be beneficial. So the conclusion was overall, additional cycles before 7 a.m. Likely to have limited benefits, and there's obvious costs that we've discussed. Settlement cycles up to a maximum of 3 later after 7 a.m. Could have some costs, but the benefits are more likely to outweigh those. And again, there are a lot of practical considerations, and we'll talk about the limitations of the study, but that's an interesting thought experiment and food for thought as we think of next steps and we have these sort of discussions.
That's great. And you just mentioned the headline for our next question, which are the limitations. And all studies should be aware and should make clear the limitations. From our side, I mean, from the modeling part of FNA, I always like to quote a phrase by a renewed British statistician, George Box, who said, "All models are wrong, but some are useful." In this case, I think that the modeling it's a very good modeling, in the sense that because of the knowledge and all the information that we got from CLS, we have a very good digital replica of or digital twin of how CLS works. I mean, I think that we have covered most, if not all, the design features of how CLS settlement works. So we have a good digital twin. But also one part of the digital twin is using data, having data to run the digital twin. And that's where some assumptions had to be introduced, because we cannot have all the information, not all the information to be processed in digital twin. So we had to work with synthetic data, which is very handy, but obviously it has some cost in the sense that there are assumptions there. So that's one of the limitations, and that's something that we could work a little bit more to make the synthetic data better. And that's always, there is always space to make synthetic data better. But there are also some other considerations that we can mention, which is we are including the most active, the most important currencies being traded via CLS. We could add more. Also, we could introduce something that you mentioned a couple of minutes ago, Emmanuel, which is we are not modeling the agents, or we're not modeling the participants as adaptive agents. And as in any model of complex systems, normally what you would try to do as well is to start introducing adaptiveness, adaptive behavior better from the participants to recreate those second order effects that changing the time and the frequency of the netting cycles could create in the system. And that's something that's challenging, that's not easy, and that's most likely a good avenue for research and modeling that we are leaving open for following projects. So that's like our limitations are from our point of view of the modeling. How about you, Emmanuel? What do you think?
Yeah, no, those are very interesting ones, and in a similar way to how models could be wrong, also thought experiments are based on assumptions. So I think it goes without saying that getting external validation from the market itself around some of these estimations is imperative. You know, the study noted that 500 billion is the size of the same-day FX market. I mean, some proxies that we looked at would actually estimate the number to be even bigger. But you know, the study also noted that 500 billion, if we take that as a conservative approach, might be the upper limit of the same-day FX market that could theoretically settle via PVP settlement. In practice, there could be various, you know, constraints that may limit the extent to which that same-day market could become eligible for same-day for PVP settlement in CLS settlement. I know I've seen some of the questions coming through, all of which are very interesting, but someone mentioned client eligibility earlier, so there could be things like client eligibility requirements, capabilities of Nostro's accounts, and so these are practical considerations that might limit the actual amount that could become eligible for PVP settlement, even if you have additional cycles. And the other one was around the cycles themselves. So when we looked at cycles after 7 a.m., for example, we try to look for additional cycles, again, as a thought experiment, that would maximize the overlap of the RTGS systems of the respective currencies we wanted to target. And so we said first cycle happens at 7 a.m. Someone's asked why that's the case. That's a sort of it's a nice hour when it's a zone where multiple RTGS systems overlap. So we kept that as is because it's a current cycle. But then we said let's look at cycles at 11 a.m. and 7 p.m. Because the second cycle of 11 a.m. has CHF, euros, USD, GBP, and CAD pair. So you're getting a lot of volumes through those as well. But again, these were theoretical assumptions. So getting practical feedback and maybe having a more exhaustive set of settlement scenarios would allow us to then do more accurate modeling as well.
Emmanuel, that's great. We're running out of time, so the final question, it's about, and we always do this in the payment system broadcast, is about you using your forecasting or foreseeing your crystal ball kind of view of what are the next steps from here. How will these findings feed into the broader conversations in the FX and the payment ecosystem?
Thank you, Carlos. Yeah, I wish I had a crystal ball. I don't, but I think what we wanted to achieve with this study really were the two things, right? Firstly, we wanted to put the netting efficiency on the map as not as just an afterthought, but as a very important consideration. When we talk about same day or even instant solutions, it is imperative to understand that correlation because there is such a cost involved with going towards instantaneousness, and sometimes can become prohibitive. So number one, I think what we wanted to do is just put that back on the map, and we look forward to receiving feedback and seeing how the community, getting the thoughts of the community. And then the second thing we wanted to put on the map is, well, to explore theoretically if there is actually merit to not instant settlement, but to multiple cycles per day. and under which scenarios, under which, when should those cycles take place to maximize the benefits. So I do really look forward to engaging with the market on these conversations. And I know, Carlos, that we have plans for additional webinars. So I will say that the Q&A, very interesting questions that have come through. I know we're limited on time, but we'll take this away and hopefully we can provide some offline commentary and answer people's questions.
That's great. We have 5 minutes left, and I'm going to start with the Q&As from the public. And I'm going to start with one that you just mentioned something. I'm sure that you read it and you were talking about that. And this is a good friend and colleague that we have already discussed this on LinkedIn a couple of times, which is, I'm going to read it. The positive correlation between liquidity needs and settlements frequency seems intuitively wrong. It seems to rest on the assumption that a single settlement cycle naturally maximizes the amount of netting. But with more frequent settlement cycles, there can be reuse of the currencies both. This should reduce liquidity needs. And I'm going to give you my view on this. This works on a perfect world. If everything is perfectly synchronized, this may work. But as we have tested, not only with CLS, but with many other payment systems, under the assumption and under the behavioral patterns of the participants that we know, this doesn't work. I mean, this correlation is not only intuitively right, but the numbers back this. What do you think about this question or comment, Emmanuel?
I agree, and I think the important thing is the time. So it's not so much the number of cycles themselves, but it's the implication of having multiple cycles. So the more cycles that you have, the less time that you have to then find offsetting flows. Again, it goes back to that train example. If you had trains running in very quickly between stations and picking only one passenger, in theory, you could be moving passengers very quickly, and that's great. But you would not be allowing time for the trains to fill up and maximize the efficiency of getting passengers quickly from A to B. And you might end up actually getting the passengers later because everyone has to queue up. I mean, I know it's not a perfect analogy, but I think we should think of this as not just the number of cycles just themselves per se, but the implication they have on the timing allowed for offsetting trades to cancel each other out.
And I would say that the keyword there is synchronicity. I mean, if you achieve perfect synchronicity, I mean, the passenger stepping into the fast-moving train, that's great. But I think that's very difficult to achieve. But that's something to test anyway. Other question that we could address in the time that we have: why 7 a.m. CET is the reference of the additional why is this the reference for the study?
Yeah, so look, today, as I mentioned earlier, CLS runs a cycle. The settlement cycle begins at 7, and the target completion time is at 9 a.m. And then the pay-ins and payouts of long balances continue well after that until 12. So when we thought about additional cycles, we thought, how can we minimize the impact on liquidity? So if you were to have additional cycles, we thought, let's keep the 7 a.m. untouched, because that's already, a well-tested, system with the right times. And then the additional times, the 11 a.m. and the 7 p.m. additional cycles, they were sort of more theoretical and hypothetical in nature, which is where the limitations of the study come in. So those additional cycles are the ones that we want to get feedback on and test. But the 7 a.m. is already it's a pretty well tested way to prove that the system is efficient. So the 7 a.m. is not so much in question. The question really is, could there be additional times for the additional cycles, perhaps?
Great, and I'm going to have the last one, which is very interesting, because in the payment system broadcast, we have been mentioning a lot of the fast payments systems, which is, the question is the following: why some jurisdictions are not choosing the DNS, deferred net settlement, between financial institutions? What do you think? I know this is not CLS, but this is related to what we're doing in this study. What do you think?
Yeah, so I think sometimes we conflate the world of payments with FX, and I think in some jurisdictions the deferred. So there is in every system, right? Let's take the UK market, right? You have FPS, that's deferred net settlement, and so what you have is a legal framework that allows the automated crediting, the instantaneous crediting of people's accounts, because people have already pre-funded their accounts into FPS in the Bank of England. But you also have CHAPS, which is not a deferred netting settlement system, and that has certain costs associated with it. So as a customer, as a retail customer, when you go and make an FPS payment, it's free usually for the most part. I know businesses maybe get charged, there's a different business model there. Whereas with Chaps, typically banks will charge you £25 or even more, depending on customer on customer relationships and tiering. So it's not so much that, you know, they both have their own benefits, but as you can see, when you start to move things to become faster and more instantaneous, you then also have costs associated with it, costs and that get passed on to the customer. So again, this study isn't to say that there is no room for instant solutions. Instant and T0 solutions exist in the FX market, but they remain niche for the same exact reason, in that there is a cost involved with them.
Thank you, Emmanuel. Thank you, everyone, for attending. Emmanuel, it has been a very interesting, nice conversation. Thank you, everyone, for joining us today to the Payment System Broadcast number 21st. Thank you, Emmanuel. See you soon, everyone.
Thank you, Carlos.
Thank you very much.
Everyone.